Gold investment rule: not afraid of losses, with 8 principles to help invest successfully, from Sir John Templeton. The speculative market was born in gloom, grew up with skepticism, developed by optimism, and died by satisfaction. Sir John Templeton is one of the most successful investors of all time. He became a billionaire as a true pioneer of global diversification mutual funds, including the Templeton World Fund, founded in 1978. The Templeton Growth Fund has earned an average annual rate of return approximately 14% in the period 1954 to 2004, much higher than the 11% of S&P. When he was born, John Templeton was born into a poor family in Tennessee. Thanks to the scholarship, he studied economics at Yale and graduated with a top position in 1934. After that, he continued to study Oxford with a Rhodes Scholarship and earned a master's degree in law in 1936. Returning to the U.S., he went to New York as an apprentice to Fenner and Bean, one of Merrill Lynch's precursors. 5 years later, he launched his first investment management company, Templeton, Dobrow and Vance, in the depths of the Great Depression of 1937. The investment management company was quite successful. Assets increased to $300 million with 8 mutual funds under its management. The company name was later changed to Templeton Damroth and sold in 1968, at the time when he started over with his own Templeton Growth Fund, based in Nassau, Bahamas. Templeton also chose to avoid the Wall Street by investing heavily in the UK and Japan markets. This helped him become a wealthy billionaire and at the forefront of global investment trends. Also, thanks to the in-depth studies of the market, his time planning is always perfect. From the first phase of the booming share of technology and internet stocks in the 1990s, Templeton gained a significant position in the stock market of the sector and earned himself a fortune. Over the next 25 years, Templeton created some of the largest and most successful international investment funds. He resold funds named Templeton in 1993 to Franklin Group. In 1999, Money magazine voted him the greatest investment stock option of the century. Templeton was also knighted by Queen Elizabeth II for her achievements. After retirement, Templeton became a very active philanthropist around the world through the John Templeton Foundation. The foundation has funded a lot of mental and scientific research. Every year, he donates about $40 million to charity funds, but he is still very devoted to his natural gift of research on securities investment. As one of the leading reverse trend investors of the 20th century, John Templeton was considered by investors to buy stocks at the bottom of the Great Depression, selling at the top of the internet boom period, and having countless other successful investments between these two periods. His investment style can be summarized as searching for valuable stocks, which he calls bargain hunting, by searching among many companies in different countries instead of just one country. Templeton's investment mantra is quite special. Making money at all costs always fails. Every path to success needs to be thoroughly researched and researched. He also said that experience and knowledge are one of the most important factors to become a successful investor. Here are 8 summarized tips for public investors who wish to succeed. 1. When investing, you need to be interested and passionate. But if you only love it without giving up your research time, you will be at risk. 2. If you are just an amateur investor, promote your existing knowledge to invest in reputable companies. Sometimes, a strong investment trust will help you win against professional competitors. 3. No one can predict the future. Along with predicting the economic and market situation, investors should take into account the risks that stocks can bring. 4. Always buy stocks at a safe margin of safety. Everyone loves buying when they are discounting. Completely similar in stock trading, knowledgeable investors are always the ones who want to buy stocks at prices significantly lower than their values, often only when businesses fall into a state of crisis. Panic. The lower spread is the margin of safety, which is a safe distance to prevent the risk that the intrinsic value of a stock will fall against the value at the time the investor buys. Depending on the degree of caution, Each investor accepts a different margin of safety. 5. Managing investments very closely. Templeton noted that no stock could hold the number one position forever. Markets are in a constant state of change and can change immediately. If investors don't recognize the change, they will lose money. 6. Investors have the answer to every question who doesn't understand the question. Do not be overconfident when entering the market. According to the interpretation of the Bible, failure will come after pride. Overconfidence in investment style will definitely lead to failure. 7. If you want to invest in stocks for a long time, but don't want to spend time and effort to be in stock market hours, you can invest in funds that have a model like stock investment. Risk RO will be less and gain more benefits. 8. Finally, keep in mind that you should always keep a portion of your capital in cash, never invest all your money in stocks.